What's up everyone, it's Caddy with MoneyVest. So in today's video, I'm going to be breaking down one sector, one ETF that I recently started buying. I sent out an alert in our Discord and our community today. And this is an ETF which I believe is going to perform really well in 2024. This is one sector which I mentioned towards the end of last year, so Q4 of 2023, that I believe as rates are expected to come down in 2024, there's going to be a lot of potential opportunity in this particular sector. There's over 2,000 stocks here in this ETF that we're going to go over. Of course, there's going to be some companies that are not profitable. In fact, 40% of this ETF is not currently profitable and does have a lot of floating rate debt, meaning as interest rates continue to come down, their interest expense is going to get lowered and the earnings per share is going to increase in 2024, so this year. As always, make sure that you drop a like, subscribe to the channel. If you are just joining us for the first time, link to our Discord, Patreon is going to be down below. There is a 16% annual discount that's available until the end of this month, so you can take advantage of that. And I've opened up a couple more spots if you're interested in joining. And of course, you do get access to all the buy and sell alerts, options alerts, trade ideas, everything's going to be included, as well as our intrinsic value spreadsheets and of course 45 plus private videos that are members only content. And do connect with me on Instagram as well. My ticker handle is going to be CASWRP as well. So this sector is going to be IWM. That's going to be small cap Russell 2000. As we already know, it's been on a very solid uptrend, but over the last year, maybe year and a half, about 18 months or so, it has underperformed the S&P 500 because the tech sector, which is big tech and of course large cap tech, has been a very, very concentrated trade over the last year, and it's been very overcrowded. As a result of that, small caps have been very sort of under-owned in the last 12 to 18 months. But this right here, as you can see, is the consistent uptrend over the last since 2001, and there's been instances where this sector has outperformed the S&P 500, which is exactly what I'm going to go over in this video, because as you'll notice, this particular chart, we are now back down to the same levels as we were 23 years ago. So back in 2001, this index, as a result of the S&P 500. So this is a relative performance chart. So what this basically means that if this is actually pushing higher, meaning that this sector is outperforming the S&P 500. In other words, IWM is performing better than the S&P 500. If it's going sideways, that means neither the S&P nor the IWM Russell 2000 is performing better or worse. And if it's been going down, that means IWM is performing worse than the S&P 500. And that's exactly what we have seen since 2015. So over the last 7 to 8 years, we've seen S&P perform much better compared to the IWM small caps. And this right here is the same level as where we were back in 2001. And right now, of course, we're back at those levels. So moving forward, right, this is where things get interesting. The fact that we are once again at a 20 plus year low, 2-decade low, is where things get interesting because rates are about as high as they're going to be. There's a very significant potential for rate cuts in 2024. The market's pricing in 6 to 7 rate cuts. And as we know, the Federal Reserve's told us 3 rate cuts. Of course, a lot of that depends on where inflation ends up going. So if inflation continues to trend lower, if you do see prices continue to come down, especially for energy has been pulling its weight, but food and of course shelter prices, shelter makes up about a third of overall inflation. So if that continues to trend lower, that's going to be a little bit of a motivation. That's going to be more of an sort of incentive for the Federal Reserve to cut rates. And as rates come down, 2 things are going to happen at the same time. Number one, valuation. Small caps are trading at a very reasonable valuation. In fact, I'll go over some of the statistics here that are going to be very interesting. Number one. Number two is going to be the floating rate debt that I mentioned earlier. Because of 40% of Russell 2000 companies are not profitable, and they do have a lot of debt because they don't get the most favorable terms. They don't have a lot of cash. They're not cash-rich companies to begin with. That's going to boost their earnings per share because their interest expense is going to be lowered as a result of lower interest rates. Now, this right here is a lot of consolidation. So coming back to this chart, what you'll notice is there's 2 different uptrends playing out at the same time. This right here, very nice higher low. This right here, another higher low over here. This is a much bigger and sort of like a higher low, which is a little bit lower than the previous ones. And this right here is the same one as before. And this is going to be that resistance sitting roughly at 236 for IWM. That's going to be $224 is going to be that level. And we've mostly been consolidating sideways and we're starting to move back higher. This week, I did decide to sort of finally start a position today. And my plan is to continue to dollar cost average throughout the course of 2024 as we continue to see more potential upside in this particular part of the market. Now, this is the underperformance. So in the last last 5 years, you'll notice a compounded annual growth rate of just over 7% with a 10-year CAGR of 6.5%, which is half of the S&P 500. The S&P is seeing a compounded annual growth rate of almost 12%. So, of course, in the last 10 years, had you invested in IWM versus S&P, your returns would have been half of what it could have been in the S&P 500. Now, moving forward, like I said, we're back down to a level which we haven't seen in over 21 years. And the most important thing here to point out is the fact that we did see a lot of outperformance after 2001, right? So after the dot-com bubble burst, tech valuations were way too high. And again, prior to 2000, we had a lot of overcrowded trades in tech. Technology was doing really well prior to the dot-com bubble bursting. And after the fact, we saw, of course, IWM perform a lot better and push higher compared to the S&P 500. So there was a lot of outperformance taking place after 2001, so post dot-com bubble. Now, here are some stats that I also want to break down. So first of all, small caps are vastly underowned. These companies typically valued between $300 million and $2 billion. That's why they're small caps, and a lot of the money has kind of flown into large cap tech. They currently make up only 4% of the overall US markets, which is half of the long-term average of almost 8%. It's been this low only twice before, March of 2020 actually, and then during 1930s as well. And big tech's dominance has played a role here because, of course, we've seen the liquidity kind of flow into large cap tech. And the second is the picture is likely to turn in favor of Russell 2000 because these firms carry more debt and have a higher proportion of floating rate debt compared to their S&P 500 counterparts. And third, small caps could see a boost from the reshoring trend, which is bringing manufacturing operations back to the US because of geopolitical and supply chain risks, diminishing cost advantages, and other factors as well. And finally, we got a big valuation call because they're trading at almost 20% below their long-term averages, with their heftier counterparts are cruising it up to 20% above their usual. So as we have already looked at Magnificent 7 and technology stocks, they're obviously trading at a much higher premium valuation compared to their long-term averages. And Russell 2000, on the other hand, trading at 20, almost 25% below its long-term average as well. And finally, of course, Tom Lee, who's one of the most bullish analysts out there on Wall Street, also expecting small caps to see a 60% rally in 2024, with valuations signaling a big run ahead, is what they also mentioned as well. So this right here, so see, Tom Lee said on Tuesday, the valuation of small caps relative to the S&P haven't looked this appealing since 1999, so again, in over 20 years, and that was a launch point for 12 years of gain, again, which is represented by the earlier chart that I mentioned earlier, considering how much outperformance we saw back exactly at where the IWM was relative to the S&P 500. So this is a very, very important chart to take note of, because we're down to that 0.38 correlation level, after which we saw a significant outperformance, which lasted about 12 years, because we kind of ended in 2011, towards the end of 2011, going into 2012, and that's really when we started to see a little bit of sideways consolidation, and then that underperformance taking place relative to the S&P 500 as well. So that's really going to be the analysis here. IWM, another sort of for investors, traders watching this video that might be a little bit more aggressive on the risk curve, might want to take a look at TNA as well. TNA is very similar to Russell 2000, but it is levered 3 times, so you got to be very, very careful. And TNA, since it's got that decay factor, you want to be very careful how long you hold on to TNA, because IWM for me is going to be more of a medium to long-term hold. TNA is only going to be from a trading perspective, considering how levered it is and how volatile it could get moving forward. So hope you all enjoyed this video and found it helpful. Let me know your thoughts down in the comment section below for this, and make sure that you drop a like and subscribe to the channel. Again, links to our Discord, Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.